Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Rick Rule. He is the chairman of Sprott U.S. Holdings, and Rick has been on this show a number of times in the past. He really doesn't need too much of any introduction. Those of you who are familiar with this industry at least know him well, know his name. He's been around for quite a few years with lots of experience in the resource sector among mining and energy companies. Really is as much an expert in the energy field probably as he is in the mining sector, but very well known, very well regarded in both areas. And indeed, Doug Casey, it was on this show one time when he was along with Rick, said of Rick that he is the best investment advisor that he has ever met and known. So those are pretty high compliments coming from a very successful investor himself, Doug Casey. Welcome, Rick. It's really good to have you with me again.
Always a pleasure to be with you. Thank you.
Always good to have you. And how are you feeling these days, Rick? I know you had some surgery and you're doing really well. When I saw you the last time, you look like $1 million. I should say $1 billion.
I'm delighted to say that both the surgery and the underlying condition that caused the surgery seem to be under control. Of course, I'm still afflicted with the maladies that one might expect a 62-year-old to be afflicted with. But the truth is I feel great for the first time in a couple of years, which is a wonderful blessing. Thank you for asking.
Oh, that's really good, Rick. I'm glad to hear that. Before we get started here with some of the questions I want to ask you, I would like to tell my listeners that there is an important investment conference coming up in July in Vancouver that I know you're very much a part of, known as the Sprott Stansberry Vancouver Natural Resource Symposium, and it will be held at the Fairmont Hotel July 28th through the 31st in Vancouver. Listeners can go to Jay Taylor Media and click on the rotating banner there to learn more about this event. But Rick, perhaps you could just tell our listeners a little bit about it. What's going to transpire at this event?
Well, we're excited about it for a number of reasons. This will be the 20th anniversary of this conference. It was started by Agora Publishing some years ago. I guess what sets the conference apart is really threefold. The first is that unlike many investment conferences, this conference will feature as keynote speakers a number of industry spokespeople too. The team that built, as an example, Franco-Nevada, Silver Wheaton, of course Robert Friedland will be there. And we think it's important for investors to talk to entrepreneurs who have built very large companies about the lessons they learned building the companies and what the important attributes in the mine building and company building process are. The other thing that probably sets this conference apart from other conferences is that attendees have told us for years that they considered the exhibitors to be content. Most conference sponsors consider the exhibitors to be advertisers.
Sure.
And at most conferences, the qualification to be an exhibitor is basically a pulse and a check that cashes, of course in reverse order. The attendees have told us that the sponsors aren't advertisers, that they're in fact content too. And so from the Sprott viewpoint, for better or for worse, we have to be decent-sized shareholders of all of the companies that are invited to attend. We said to our attendees, we understand what you're saying with regards to exhibitors being content, and while there's no guarantee that every one of the exhibitors will become successful companies, there is a guarantee that we are interested in them enough and know enough about them that we own them with our own money. As far as I know, this is the only conference that follows that format in the world, and we think it's very honest.
Well, it certainly sounds like it. You put your money where your mouth is, and I think it's very wise for people to pay attention to people that do that. So it's Rick, I'd like to ask you, our favorite metal, mine at least, and I suspect it's yours as well, gold. It was perhaps a year ago or so when you were on this show, and I was at least. I don't know that you were lamenting the decline in the gold price, but I was. And you reminded me that I'm old enough to remember the last time we had a major bull market. We had a secular bull market in the 1970s. Gold dropped from around $200 to $100, and this was about the time when gold had fallen from its lofty $1,900 to a little under 1,200 or so, I suspect, somewhere in that range. And you reminded me that, listen, Jay, you know, we've been through this before. It will recover again and probably will go on to new highs sometime. I think you said that. We just had Michael Oliver, a technical analyst that I hold in high esteem, with us earlier today. And he's very firmly of the opinion that we are in a bottoming process and the worst is most likely over with. He's not absolutely sure of that, but where do you stand on that? Do you think the worst is over with, Rick, on gold?
I don't have any skills as a technical analyst, Jay, but my suspicion, my conclusions are probably the same. And I say that for several reasons. When we talked before, I said that there were 60 or 70 factors that are cited as being the cause of gold's weakness, but I believe that gold is locked in a war with the U.S. dollar. Mm-hmm. And the U.S. dollar's supremacy, I think, hegemony, in fact, has been responsible, in my view, for most of gold's weakness. You know, Jay, that if you measured gold's performance in almost any currency in the world for the last 13 or 14 months other than the U.S. dollar, that gold is already in a bull market. Yeah. And gold has done the job that it has been hired, if you will, to do through millennia in most currencies other than the U.S. dollar. Of course, you and I spend U.S. dollars, so we need to measure gold's performance in U.S. dollars. And there I think the trends are encouraging, too. First, it's important to note that there are $4 trillion in sovereign securities worldwide that have a negative real yield. And I would argue that the number is actually much higher if the nominal yields were priced accurately. Right. The benchmark global security, of course, is the U.S. 10-year Treasury, which promises to yield you 1.8% in a currency that the government acknowledges is depreciating at 1.6%. So if you use their numbers, that's giving you a 20 basis points or 0.2% yield. What they're really saying to you is that if you give them money for 10 years, they absolutely, positively promise to give you back less than you gave them. Jim Grant famously calls that return-free risk. Yeah. And I understand that the attractiveness of sovereign instruments is people's fear of general market securities. I get that it's a fear trade, not a greed trade. But from my own viewpoint, the promise that they're absolutely positively going to give me back less than what they gave me guarantees me a loss, which is not very attractive. The second part of that, Jay, which I think is very bullish for gold, is that 6 or 7 years ago, your real cost for holding gold was the positive return on the U.S. 10-year Treasury. It was at 6%, which meant that by owning gold, you were forswearing 6% interest on a nominally return-free risk. In other words, there was a real cost associated with holding gold. The fact that the alternative is not very attractive and that the real holding costs of owning gold have gone down caused me to suspect that the next while, and by while I mean 2 or 3 years, will be quite positive for gold. And that is absent exogenous shocks.
Mm-hmm. Mm-hmm. Well, that's certainly promising, I guess. We've had a period of weakness here, though, and it's been a great time for people with money to pick up assets. We were just talking to Abraham Drost of Carlisle Goldfields, and looking at that looks like a good situation. I don't know if you're familiar with that one. I know you certainly at Sprott are looking at undervalued assets. That's been your forte, essentially, to be able to pick up things, to pick up value, and you've done a remarkable job, which is why you've been so successful, I suppose, Rick, over the years. But I want to ask you, you think we might be seeing an improvement here in the fortunes of the gold mining companies already? Because I'm looking at Newmont's first quarter earnings. They came out much, much stronger than the analysts were expecting. I saw that the gold price declined. The cost of producing gold fell by about 19%. Now, whether they're doing it by higher grading, I haven't dug into the numbers enough to understand to know that for sure. And I know a lot of their improvement also came from copper production. They increased their production with a recent copper acquisition I think they made, and but that cost of producing a pound of copper went down by 51% to $1.33 or something like that. I think that's a cash cost. But do you have a sense of whether or not maybe the gold miners, the big guys, might be turning the corner?
I think they are turning the corner. We've talked before about the fact that for many years mining companies made poor investment decisions because they viewed themselves really as warrants for higher gold prices rather than good operating businesses. And the outperformance in the market of companies that generated free cash, like Goldcorp, Franco-Nevada, and Randgold, I think has been a lesson to the rest of the industry. And I think the rest of the industry is learning the lessons, including, of course, Newmont and Barrick, which is a helpful thing. I'm not trying to say that the gold mining industry is yet a well-run business. It's not. But it's a better run business than it was, and that will inure to the benefit of shareholders. I think maybe more exciting for your listeners is the fact that the junior markets have continued the trend that we identified a year ago, which I called bifurcation. And that suggests that although the TSXV, which is still off 80% in real terms, has separated in effect into two industries where the best 10 or 20% of the companies on the index have truly separated from the past, and never mind have bottomed or on their way up. That's evidenced by the financings available to the better quality teams. Now, it isn't apparent in the index because the index is still polluted by so many companies with negative working capital and no reason to exist, the so-called zombies.
Yeah.
But the truth is that the better companies in the industry, the better junior companies in the industries are up 20, 30, 40% from their bottoms. And a real recovery is underway on a qualitative basis. And it's precisely this qualitative recovery, the fact that the best companies in the industry lead, that will eventually lead the rest of them out of their doldrums. In this particular case, the sins that existed during the bull market of the last decade were so manifest that it's likely that the recovery process will be much more gradual than many of your listeners would like.
Yeah.
But the truth is that the best of the best aren't merely bottoming. They're in a bull market of their very own.
Yeah, and speaking of juniors, let's talk about a fund that Sprott has recently set up it's an ETF, in fact, for junior mining companies. I guess the symbol trades on the New York Stock Exchange. The symbol is SGDM, I believe, Rick?
Yes, we actually have two ETFs now. We have one SGDM for the majors. It was our point of view that the existing ETF, the XAU, made a mistake by being market cap weighted, and we decided to do factors-based investing, things like the generation of free cash relative to debt, and revenue increases so that we wouldn't buy industries in liquidation. That was a very successful product launch, although we launched it in June of last year in an atmosphere where one of the worst performing major market sectors in the market was gold mining. We were still the 9th most successful ETF launch in the United States last year, which says something about the high regard that the industry still has for gold mining, and we hope for Sprott. Much more recently, we've launched a junior mining index, and again, not market cap weighted, but rather factors based. We believe that the best of the juniors will substantially outperform the junior market in the next 2 or 3 years. And we suspect that the recovery that has already begun to occur has been qualitatively weighted. So we've now started a junior gold miners ETF to mirror the success of our senior gold miners ETF, and we're very excited about this product launch. As you know, we've been intimately involved in the small cap, mid cap, and micro cap junior mining market for many years, and we thought that this ETF was a wonderful addition to retail investors' arsenals, and we're proud to have sponsored it.
Yeah, no doubt about it. I mean, between you and the Sprott organization yourself, before you joined Sprott, I don't know of anybody that has been probably more into the junior mining sector than your two institutions. So it certainly you would be as appropriate to launch something like this. What is the name of this fund, Eric and Rick? And
the Sprott Junior Miners Index.
Sprott Junior Miners Index. All right. Well, we'll certainly start to follow that. I called you Eric. I'm sorry. It's Rick Rule, Eric Sprott. But anyway.
I'm not embarrassed to be called Eric.
Yeah, you reminded me that it's his name on the door. But nonetheless, you have become a very important part of that institution. And really glad. I think it really is a fantastic organization, Sprott, and I've learned to know some of the people there. Really a strong management team that you have. You know, you have now gotten involved in a hostile takeover of the Central Gold Trust and the Silver Bullion Trust. I've known of these trusts. CEF is another one. It's a gold and silver trust that my friend Ian McAvity has been involved with, I think, over the years. And in any event, I sort of felt like Adrian Day, his viewpoint was, why change it? I like to buy gold when it's undervalued. I mean, these funds have tended to trade either significantly below their NAV or significantly above. During bear markets, you can buy the metal really inexpensively in that way. In bull markets, you have to pay a premium. So, I mean, Adrian has said, well, I rather like being able to buy gold cheaply, so just leave me alone. But you are launching a fund, and clearly, it's an inefficient market if it's not priced close to NAV. But could you explain to our listeners? I mean, is it just this arbitrage opportunity, or what are you doing here, Rick? Why the hostile takeover?
We have been asked for years, and I personally have been asked for years by many central fund shareholders to improve the governance of central fund. We believe that the Sprott Trust products are better products. We believe that they're better products in the first instance because they're redeemable for precious metals. Mm-hmm. A unit holder in the Sprott product, a sizable unit holder I should add, can redeem their trust units for physical metal. And that makes our product a much better proxy for physical metal. The consequence of the fact that our funds are redeemable, where theirs are not, is that ours sell at or near net asset value. And many shareholders of the central fund product have said that they want a paper proxy that offers up the convenience of an exchange-traded product, but is in effect a proxy for gold. They don't want to buy something that trades at a 12 or a 15% discount to gold if they need their cash. Because there's two decisions. There's a buy decision and there's a sell decision. And finally, I think it's very important for North American investors in particular who are really concerned with security to know more about the investment manager. I'm not casting dispersions on the Spicer family because I don't know their financials. And I know their financials because they're not public. Mm-hmm. When you look at who runs the Sprott products, it is Sprott. It's a public company. You can see our balance sheet and you can see our income statement every 3 months. And by the way, they're damn good. And I think it's important that you know something about the financial condition of the manager and sponsor of your financial products. And so for those three reasons, the fact that our products more accurately mimic the price action in gold, silver, and platinum and palladium, because our products are redeemable and theirs aren't, and because they've had 15 years to change that feature in their product and haven't chosen to do it, and because increasingly investors demand knowledge as to who the sponsor and manager of their investments are, we have decided that we would be better stewards of the capital, the investors' capital represented in these markets than the existing management team. And by the way, large individual investors and small retail investors across the length and breadth of North America are agreeing with us.
All right. Well, it certainly makes sense, Rick. It's hard to argue with those 3 points that you just made. I must say that. It's although I don't at the same time don't disagree with our friend Adrian as well, who sort of like to buy cheap and sell low. But I guess if you're, who knows when you might have to sell, and then you have to sell something at way below the NAV, which wouldn't be a happy circumstance either. So,
both Adrian and Ian are personal friends of mine, and I would be delighted to have a public discussion with one or both of them.
That would be fun, and it would be in a good spirit too. I have no doubt about that, Rick.
I think the facts in this situation are quite clear. And, I think they need to be. I think they need to be discussed in a public format.
Well, we're doing it here from your side of it, and I guess Ian would be welcome to come on and talk as well to present the other side. But anyway, thank you very much for that. With a couple of minutes left here yet, I just wanted to ask you real quickly. You did an interview with Tekoa da Silva recently, in which you stated that we haven't seen capitulation in natural resources yet. And that was about 2.5 months ago or so, Rick. Do you think we're there yet? Are we close? I mean, you give your opinion on gold. You think we may be probably pretty close. But what about the general commodity sector?
We have not seen a capitulation in resource equity markets. These capitulation, well, you'll know them if you see them. a capitulation is a truly ugly sell-off, nor have we seen issuer capitulation. There's no necessary God-given law that says we have to have a capitulation before the markets turn up. What capitulation is useful for is it, in my experience, has marked the end of a bear market, and I would have been much more comfortable calling for rapidly recovering markets had I seen a capitulation. The consequence of no capitulation is that the recovery, if that's what we're in, will be more saucer-shaped.
Yeah. Well, we'll have to leave it go at that. Rick, thank you very much. I could go on and on with you for another hour, but we are out of time. So thank you very much for being with us. And folks, again, check out all that Sprott has to offer on their website. Rick, the website would be Sprott. Do you know what it is offhand?
www.sprottglobal. That's SPROTTGLOBAL.com.
Thank you very much, Rick, for being with us. Thank you so much. We'll look to do it again sometime soon, I hope.